The investing blueprint for inflation, deflation, or a recession. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over a recap of Chris Cole's Dragon portfolio we discussed from Friday. If you didn't see that video, we'll put a link in the description below. Our chart starts at 1928. Goes to today, and it runs in cycles. Chris Cole calls these cycles hawk or serpent. A serpent cycle starts off very strong due to a free market economy, technology, demographics, but then at the end of the cycle, it becomes very corrupt with crony capitalism, a massive expansion of debt, and of course, money printing. Then the hawk cycle comes in and wipes the slate clean. It gets rid of all the malinvestment and the misallocation of resources, and then it issues in another serpent cycle. Our chart starts at 1928, goes all the way to today's date. On the left-hand side, starts at $1, goes all the way up to $48. So starting off in 1928, if you would have had $1 in Chris Cole's Dragon portfolio, at the end of this hawk cycle in 1946, you'd have $6. You can see during every cycle, regardless of whether it's a hawk cycle or a serpent cycle, the Dragon portfolio performs extremely well, especially from 1965 to 1983 when we had an inflationary hawk cycle. More on that in just a moment. And looking at the pie charts, you can see how the Dragon portfolio is extremely unique. On the left-hand side, a normal portfolio, 73% equities, 21% bonds, 7% cash. But then we go over to Chris Cole's portfolio, 24% equities, 18% bonds, 19% gold, 18% commodities trend following. This is where it gets interesting. And 21% long volatility. Step number 2. Let's take a deeper look at the hawk cycle. This is the deleveraging phase we're most likely in right now and will be in for the next decade. Chris Cole describes this as the left wing of the hawk and the right wing. The left wing is a deflationary deleveraging. The right wing is an inflationary deleveraging. He's got some charts in his report that go over this beautifully. They're a little tough to read, so I tried to simplify them here for the whiteboard. We'll start with the deflationary deleveraging. As examples, we'll use the Great Depression from 1929 to 1932 and the recession that followed in 1937 to 1938. These charts represent the equities market, so the stock market. It indicates the number of months the deleveraging lasted, from 1 month all the way to 37 months. And on the left-hand side, it goes from 0 up to 1.5. So this is what $1 invested would have done during that time period. We'll start with 1929 to 1932, and I've made this chart a lot simpler than Chris Cole's. He follows it exactly. So editor, throw that up. You can see how it goes up, down, up, down. A little tough to read, so I just made it a straight line. In 1929, if you would have had $1 invested, 35 months later, that dollar would have been down to 50%. Keep in mind, both these charts are in nominal terms. Nominal numbers, they are not adjusted for inflation. From 1937 to 1938, you would have lost almost the same amount, but in a much shorter time frame, only about 15 months. Moving down to the right wing of the hawk, this is the inflationary deleveraging. This chart specifically was extremely interesting to me. Check this out. We start with the months below from 2 months to 38 months. And on the left, we start at the top with $1 invested. It goes down to about 0.5 or 50 cents. So this is what your dollar would have done if invested in the stock market during this time frame. From 1972 to 1974, a period of stagflation. So inflation in the United States running at 6, maybe 7%. The stock market went down in nominal terms, not inflation adjusted, nominal terms by almost 50%. And even in the stagflation between 1976 and 1980, the stock market was pretty much flat. So what this tells us is that inflation doesn't always equal asset prices going up. Takes me back to what I've been saying the last month or so, that inflation and deflation is extremely nuanced. It's not binary. And the only times throughout history where we've always seen asset prices go up is in times of hyperinflation. The example Chris Cole uses in this chart is Weimar Germany, 1919 to 1923. So how can this help you build an investment blueprint for your own portfolio for an inflationary cycle, deflationary cycle, or a recession? Well, to be clear, the Dragon portfolio is set up for the long term. This is a portfolio for 100 years. So regardless of what happens, what season, what cycle, you're going to do well over the long run. But if you're looking at just the next 5 years or the next 10 years, you look at the hawk cycle. And what's great about this portfolio is you don't have to make a decision whether we're going to go into inflation or deflation, because parts of the portfolio that are meant for the deleveraging work regardless of whether it's an inflationary deleveraging or a deflationary deleveraging. In other words, it works regardless of whether or not we're going into a left-wing hawk cycle or a right-wing hawk cycle. Before we move on to step number 3 and go over specific ideas for the portfolio, I want to point out something I think is extremely important. Editor, go ahead and throw up a historic chart of the S&P 500 in nominal terms. We can see going all the way back to 1932, taking it to today, it pretty much goes from left to right, straight up without a hitch. Even if you look at the 1970s specifically, it looks like it just went down a little bit, then went right back up and kind of flat all the way to the end of the decade. But if you zoom in and look at what really happened and try to put yourself in the position of an investor psychologically, emotionally in the 1970s, we see a much different picture. Editor, go ahead and throw up a chart of the S&P from 1970 to 1980. And here it looks anything but flat. Can you imagine being on this wild ride? Starts off around 90, then plummets all the way down to, say, 73. And I know it doesn't sound like a big move, but in percentage terms, it would have been huge. Then from 1970, it skyrockets all the way up to 116, and then comes crashing down again to under 65, and then right back up to, call it 105 in 1980. It looks like a roller coaster when you zoom in, but when you zoom out and look at it over the span of 90 years, it just looks like a little blip. So my point is, whenever you're looking at the charts, regardless of whether it's the S&P, whether it's commodities, precious metals, bonds, whatever it is, look at the full historic view, but then look at it decade by decade, and definitely in percentage terms, nominal terms, and real terms adjusted for inflation. That's the only way you can get the entire picture. Step number 3! Now let's go into some specific ideas for your personal investing blueprint that'll help you survive and thrive in a cycle of inflation, deflation, and a recession. We know for sure that Chris Cole's Dragon portfolio is a great starting point for all of us. And what makes it unique from normal portfolios is the hawk portion, or the portion that does well in a hawk cycle, a deleveraging. This is long volatility, commodity trend following, and gold. For gold, I'll assume most of you know how to invest in that, or Bitcoin, whichever you prefer. Commodity trend following, a little more esoteric, but it's not impossible. It's pretty easy. There's several books out there how to do it, such as The Turtle Traders. But the long volatility portion of the Dragon portfolio is what most people really struggle with. There's no easy way to do it. There are ETFs that are long volatility, like the VIXI, but unfortunately, they almost always have a negative carry, just like USO, where they have to buy futures and roll them over when the futures curve is in contango, meaning the spot price is lower than the future prices. They always lose money over time. To understand this further, let's go right to Investopedia. VIX ETF positions tend to decay over time as a result of the behavior of the VIX futures curve. As this decay takes place, these ETFs have less money to use to roll into subsequent futures contracts as existing ones expire. As time goes on, this process repeats itself multiple times, and most VIX ETFs end up losing money over the long term. And since we're looking at our portfolio in cycles of a minimum of 10 years, we definitely don't want something that's going to have a negative carry. So the VIX ETFs are out. The other option is to invest in Chris Cole's fund. If you're an accredited investor, I definitely suggest checking it out. It's Artemis Capital is the name of his fund. But for most people watching this video, those are not realistic options. So what can the average Joe and Jane do? I suggest you start by looking at trends. If we go into a deleveraging, regardless of whether it's an inflationary or a deflationary deleveraging, society as a whole is going to become poorer, especially the retirees. We have this glut of the population retiring, the baby boomers. If we go through inflation, they're going to struggle because their Social Security checks aren't going to keep pace with inflation. If we have a deflationary cycle, their 401ks will definitely take a hit, and their pensions will most likely go bust. Social unrest will be another trend. We've seen this growing all over the world, and I think it's only going to get worse in a deleveraging cycle. We also want to focus as investors on capital preservation more so than capital appreciation. If you can get the appreciation, fantastic, but when you go into a cycle like this, your focus should be on maintaining your purchasing power. Now let's dive into some specific ideas that I came up with, and I had a lot of help from my community on Twitter. So if you're not following me on Twitter, make sure you do so, just at George Gammon. And this is more American-centric, but I think you can get some good ideas. First and foremost, farmland. I did some research and I saw that in the UK during the Great Depression, farmland did well. It also did very well in the 1970s. I know farmland did well in the United States in the 1970s. I couldn't find any data that went back to the 1930s. Trailer parks, for obvious reasons. As a society, if we're getting poorer, still need a roof over our head, we're going to look for the cheapest option possible. Payday loans, unfortunately, if the unemployment rate is extremely high for a long period of time, more and more people are going to need this type of service. Cannabis, you know what they say, when we go into a recession, the things that do well are alcohol and cigarettes. I think moving forward, you've got to throw in cannabis as well. I know a lot of these stocks have been in a bubble, and I'm not saying with any of these that you go out and buy them right now. I'm personally just putting them on a watch list. So if they do get cheap, I know I can go in and buy them because I want to hold them for the next 10 to 20 years. AutoZone or any auto parts store, not saying they're cheap right now, but I think if we go into a recession or a deleveraging, regardless of whether it's inflationary or deflationary, fewer people are going to be able to buy new cars. They need to work on their own cars, and AutoZone, O'Reilly's, that's the place you go. eBay, on the same note as AutoZone, if we're really struggling economically, people are going to need to sell some things, maybe to put food on the table, keep a roof over their head, send their kid to school. In the old days, we go to a garage sale. Nowadays, you go straight to eBay to not only buy things cheap, but to sell things to get cash in your back pocket. Coal and uranium. I know this may sound a little weird, but if we go into a recession or depression, I think the last thing on politicians' minds, or the last thing they'll be talking about, is green energy. I'm not saying this is right or wrong. All I'm saying, if society is getting poorer and we're really struggling economically, we're going to look for the cheapest, most efficient energy source possible. And as you guys know, coal and uranium is extremely cheap right now. Next, we get into some ideas that are a little more outside the box, but they're things that I'm thinking about, so definitely wanted to throw them in the video. XYZ real estate. This means in South America, in Asia, in Southeastern Europe, just anywhere outside the United States, where the culture sees real estate as a safe haven asset. Not only that, you've got Boomer Bill, whose retirement checks are getting smaller and smaller and smaller as far as their purchasing power, and Moody Millennial, who can't find any opportunity in the United States. So what do? It makes sense. Maybe you go to Mexico, maybe you come to Colombia, because your cost of living is so much lower, you can improve your standard of living. And I've seen it down here in Medellin the last couple years firsthand. I can't even tell you how many retirees I see moving down here constantly. And whenever I go to a coffee shop prior to the cerveza sickness, they're just packed with millennials on their computers trying to make money online with a side hustle, whatever it is. They're trying to get outside of the United States to find more opportunity. Now we head over to the SSMGP. Just like the Fed, we have to have a 4 or 5 letter solution for everything. But what this is the super smart macro guy plan. And I saw a video the other day, an interview that was fantastic on Real Vision between Raul Paul and Hugh Hendry, who I just interviewed for my channel. If you haven't seen that interview, make sure you do so. But I found it very interesting, the way they look at volatility in their own portfolio and in their own lives. What I mean by that is both Raul and Hugh have moved to very small islands in the Caribbean. Hugh moved to St. Bart's, Raul moved to Little Cayman. And in their discussion, when they're talking about volatility and how to structure a portfolio, they both say that that's one of the main drivers for them moving to one of these small islands. They bought real estate there, especially in Hugh's case. It's a positive carry assets. This means it's positive cash flow. He's getting paid to own it. So they take out super cheap fixed rate debt. They have a hard asset. In Hugh's case, it has a positive carry, and they're outside of the insanity bubble. Meaning that regardless of what happens in the world, even the cerveza sickness, they've got an additional level of freedom. As an example, I'm here in Medellin in an apartment, and they will not let you leave. You're on a government lockdown. It absolutely sucks. But Raul and Hugh are off on a beach. There's very few people around. They're on a big piece of property, so they can go outside, they can relax, they can get some sun. Hugh can go surfing while I'm sitting here in Medellin in a city, in a metropolitan area, stuck in my own apartment. And I know this doesn't directly pertain to investing, but it does pertain to personal freedom. And at the end of the day, that's why we're trying to increase our purchasing power, so we have more personal freedom to do the things we want to do when we want to do them. So taking this back to the United States, maybe it's not realistic for you to buy a property on a Caribbean island, but hey, maybe you want to get outside of the city, get out of the urban area and buy a rural property, maybe a little farm, maybe a house where you can grow your own food, you can get outside, get some sun, get some exercise if we go through another round of the cerveza sickness. But more importantly, for the next 10, 20 years, if we do have social unrest or if we have this insanity bubble, it'll most likely be focused in the cities. Therefore, you remove yourself, you increase your personal freedom, and at the end of the day, like I said, that's what it's all about. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this special Dragon Portfolio playlist right here, and I will see you on the next video.